The next very important concept for discussion, that is dealing with mutually exclusive projects. So before I explain you how to deal with mutually exclusive projects, you should first understand what is the meaning of mutually exclusive projects. Here we are talking about multiple projects. So suppose there are two projects A and B. You are analyzing the feasibility of these two projects and you happen to find that both the projects are giving positive NPVs, both are having good rate of return. So both are actually lucrative, both are good for making investment. But you may not be able to make investment in both. Maybe you have limited capital, or for some other constraints you are supposed to make investment in only one of these. So if you invest in A, you are not allowed to make investment in B, and vice versa. That is what we call as mutually exclusive projects. In situations of mutually exclusive projects, your criteria has to be very well planned, because you are foregoing one investment proposition, you are foregoing an investment offer, you are foregoing an investment proposal, you are foregoing the opportunity to invest in one of the projects, because if you invest in one, you will not be allowed to invest in the other. That is where you should not end up committing an error in your decision, and therefore this criteria is something very important. So what I will do is, I will be taking you through basic situations, and gradually in this heading we will be moving to little advanced discussion also. So let us first identify different situations that you will be facing. First possibility, that the two projects that are informed to you, their lives are same. That means if project A has life of 10 years, project B also has life of 10 years, same life. Their cost is also same. That means the initial investment of both the project, it is same. So that could be one possibility. Same life of both projects, same cost or equal cost for both the projects. In such situations, you simply compute NPV of the two projects. Whichever project gives you higher NPV, select that, finish it off. However, if the life of the two projects are same, but the initial investment in the two projects are different amounts, that time there will be a conflict between NPV and Profitability Index basis, and that is the very important discussion that we will have sooner, just in a short while. That whole clarification of that conflict I am going to discuss in details, taking lots of examples, and I would blend the concept of capital rationing also in this class, which has a close linkage with NPV and Profitability Index conflict. So when should you prefer NPV, when should you prefer Profitability Index as a basis? We will be actually utilizing the concept of Profitability Index in this class today. And then we have a third possibility, that the lives of the two projects are different. If the lives of the two projects are different, irrespective of whether their initial investment is same or not, you are going to apply neither of NPV or Profitability Index. You will not even compute IRR. The best thing over there would be annualized NPV. So I have shown you one small calculation in the previous example while we were dealing with question number 12, that just for sake of calculation we have calculated something called annualized NPV, and I told you we are not going to discuss that concept in this class, it will be pushed to the next class. But when we are discussing that concept, it's a very important concept, and at later stage lots of situations in financial management, whether it is capital budgeting or leasing decisions, it will have tremendous involvement of this annualized NPV or annualized value concept. So anyway, when the right time comes, we will be learning that in details. As of now, our focus point is dealing with mutually exclusive projects, and let us begin with one simple scenario where life of both the projects it is same. Cost of the two projects will also be same, and let us get started with a question on that category. Let us take up question number 14. Let us read this question. X Limited has to select one of the two projects, details of which are given below. So you find that the two projects are project P and project Q. You have been given information about the cost of the two projects. It is 10 lakhs and 10 lakhs. Life of the two projects 5 years, 5 years. So from this very first initial information, we can identify that the two projects are having equal lives. Their cost is also same. So we are simply going to use NPV criteria to identify which one of these is better. And what they have directly reported is annual cash flow calculations. So discounting rate given is 10% per annum. You are required to advise the company regarding selection of one of the two projects. So very simple. Let us see how to present the solution over here. In your solution, you just make one common table for both the projects. So just the year, annual cash flow and PV factors for each project you note down, and the discounted cash flow will be the multiplication of annual cash flow with the PV factors, and keep doing this for each year for each of the 5 years. And when you do that, you will be ready to compute the total present value of inflows from each of the two projects, which comes to 10,99,813 for project P and 10,78,251 for project Q. And now when you subtract the initial investment or the total PV of outflow from this total PV of inflow, the resulting value, obviously what you get will be NPV. So actually speaking, the cost of both the projects are same, that is 10 lakhs and 10 lakhs. So when you subtract that, what you get is NPV, which is 99,813 for project P and 78,251 for project Q. Let us move ahead, and now what we do is write up the conclusion. Cost of both the projects are same. Life of both the projects are also same. Therefore, on the basis of NPV, project P should be selected as it provides higher NPV as compared to project Q. Let us move ahead and now discuss a very important concept, that is conflict between NPV and profitability index. Let us discuss a very important concept about conflict between NPV and profitability index. In the concepts earlier and the questions earlier, you have already learned how to compute NPV, how to compute profitability index. For you to just recall, NPV, net present value, is the difference between total PV of inflow minus total PV of outflow. On the other side, profitability index, also known as desirability factor, is a ratio of total PV of inflow divided by total PV of outflow. That much you have learned in terms of calculations and the understanding. But when there are cases of mutually exclusive projects, what is the meaning of mutually exclusive projects? When you are supposed to invest in any one of the two given projects, you cannot invest in multiple projects. In such cases, if it is a case of mutually exclusive projects, you need to assess the profitability of both the projects. This can be done either using NPV or profitability index. But when to adopt NPV as appropriate basis and when to adopt profitability index as an appropriate basis, that is a bigger and more important question. Let me give you an analysis of different situations possible. Suppose the first situation, two projects given A and B, NPV of A is higher than NPV of B. Profitability index of A is also greater than profitability index of B. That means whether you talk from viewpoint of NPV or profitability index, both way project A is the one that you would prefer. In such case, there is no conflict of ranking because you take NPV as a basis, it conveys one simple signal that project A is better. You take profitability index as a basis, it also conveys the same message, project A is better. What will happen if NPV of project A is higher than NPV of project B? So NPV wise, project A is better. On the other side, you would find that profitability index of B is greater than profitability index of A. In that case, we find that profitability index basis would support the selection of project B and not project A. So in that case, there is a conflict of ranking between NPV and profitability index, and how to deal with such a situation is what we are going to discuss right now. And we will be taking a small calculative example for understanding this concept. So the first thing what I would want you to do is, please first of all write this heading, conflict between NPV and profitability index. Once you have written the heading, let us first move on to a calculative example. So for your reference, you may take question number 15 of your textbook. I'll display the question over here. Let us read that question. B Limited is required to invest into one of the two projects X and Y, details of which are given below. Now what details you have been informed? Observe one thing clearly. Project X has a cost of only 20 lakhs, whereas project Y has a cost of 32 lakhs. If you observe, life of project X is given as 5 years, that of Y is also given as 5 years. So from the viewpoint of their lives, they are indifferent. Now what they have informed is profit before depreciation and tax. Now when I read the question and identify profit before depreciation and tax, it is clear that these are the cash flows before tax. So obviously the one indication that we get is we must find out the cash flows after tax. Now scrap value is given only and only with respect to project Y. Rate of tax for the company is 30%. Now of course if tax rate is given, we are mandatorily required to convert the information of profit before depreciation and tax into annual cash flows after tax. An applicable discounting rate is given as 10% per annum. You are required to advise the company regarding selection of one of the two projects. When they say one of the two projects, it is a clear signal that these are mutually exclusive projects. So I am sure looking at the question, you can easily compute the cash flows after tax. Let us do that task first. So calculation of annual cash flows, you can have a columnar presentation for X and Y. You get started with profit before depreciation and tax. Depreciation should be subtracted. Now, are you wondering how we got the values of depreciation over here? It is simply initial investment minus scrap value divided by the project life in years, because by default we are considering straight line method of depreciation. So what we get after subtracting depreciation is profit before tax. From that you would subtract the amount of tax and you get profit after tax. The moment you get profit after tax, you add back the depreciation and you will be getting the annual cash flows, that is 6,80,000 for project X and 9,64,000 for project Y. Let us move ahead and now compute the NPV of the two projects. For this purpose, again we can have a columnar presentation. So what we will do is, for years 1 to 5, we will be using the annuity factor for the usual cash flows, where annual cash flow for project X and Y we have already gathered in the previous working. When we multiply the annuity factor at 10% for 5 years on project X and Y, we get their respective present values, but we should not ignore one thing, that there is some information about scrap value in one of the two projects, and that was particularly project Y. Project Y has scrap value of 2 lakhs which will be obtained at end of 5th year. So the 5th year's PV factor has been multiplied to cash flow of 2 lakhs to arrive at the present value of that scrap value, or you can call it the present value of terminal cash flow. When you add it up, what you get is total PV of inflow. From that you subtract the PV of outflow, and what you get is NPV, that is net present value. So what we can find clearly, that net present value of project Y is greater than that of project X. So project Y has higher NPV than that of project X. Now over here, please understand one very, very important point. If you can try to understand one simple thing, what is needed over here? Project Y is definitely giving you higher NPV. But did you observe one thing, that the initial investment involved in project Y is substantially greater than the initial investment required for project X. 20 lakhs required in project X and comparatively 32 lakhs required in project Y as initial investment. So from investment viewpoint, project X requires or demands lesser investment, project Y demands a higher amount of investment. I repeat, project X requires lesser investment, project Y requires more investment. 12 lakhs of extra investment required in project Y, and it is fetching how much extra NPV? Not even 1,000 rupees. You can see this from the calculations that we have made. Now don't you agree that blindly selecting a project which has higher NPV would not be appropriate over here? If you agree with what I am saying, that means if the investment values are different, we would be interested in knowing how much is the present value of inflow for each rupee of outflow, and that is where we bring into account the concept of profitability index. So what we will first do is, we will again not jump into conclusion so quickly. We will first compute profitability index and then look into what is the situation. So please keep patience. I'll be showing the calculation of profitability index and the reason why are we introducing profitability index over here. First you write up that matter and then we will have further discussion on this point. So let me show you the calculations first. Everyone's attention on screen please. And here we go with the required calculations. So first what you will do is NPV base. That means if you take the basis of NPV, project Y appears to be better than project X. However, the cost of the two projects are unequal and decision can be taken on the basis of profitability index. I am not concluding that decision will be taken on the basis of profitability index. I am just indicating a possibility that decision can be taken on the basis of profitability index. So let us compute profitability index first of all, which will be total PV of inflow divided by total PV of outflow, and we will calculate this first for project X and then for project Y. So what we find, the profitability index for project X is greater than that of project Y. So how do we interpret this profitability index calculation in the first order? Can you notice one thing? In case of project X, 20 lakhs of initial investment if you put in, that means if there is outflow from your pocket amounting to 20 lakhs, the present value of inflow is 25,77,735. That means from every rupee that you are spending from your pocket today, you are getting the present value of inflow amounting to rupees 1.29. So every 1 rupee of outflow is bringing an inflow of 1.29. Whereas comparative, if you see the scenario with project Y, with every 1 rupee of outflow, the resulting inflow is only 1.18. Over here, the kind of analysis that I want you to consider is something very, very important. I will give you time to note down if you haven't written, but please carefully understand the point. So here we find that NPV basis is recommending that you should take up project Y. Profitability index is recommending that you should take up project X. So there is a conflict of ranking. Now beta, here you need to have clear understanding and don't jump into conclusions rapidly. What I want you to understand is this. Look into one thing. First of all, whether the projects are divisible or not. When I say whether the projects are divisible, that means can you invest a portion of money in one of the two projects so that you can compare the two projects at parity. So what will happen? Understand one point, because right now one project is having outflow of 20 lakhs, another project has outflow of 32 lakhs, which are not at parity. Suppose you and me, we enter into a partnership arrangement where I will invest 12 lakhs and you will invest 20 lakhs in project Y. So project Y is not solely taken by you. You are investing 20 lakhs and I am investing 12 lakhs. So together our joint investment becomes 32 lakhs. So taken together, two of us becoming partners, we can invest in project Y. In that case, your investment in project Y is how much? Your investment in project Y is only 20 lakhs and your investment individually in project X would anyway be 20 lakhs if at all you invest in project X. Now use your common sense. Whatever NPV we are getting from project Y, because both of us are partners, you will be drawing one portion of that NPV and I'll be getting the other portion of the NPV. So what is the proportion of your investment? If you can see, your proportion of investment is 20 lakhs out of 12 lakhs. My proportion of investment is 12 lakhs out of 32 lakhs. I repeat, your proportion of investment is 20 lakhs out of 32 lakhs and my proportion of investment is 12 lakhs out of 32 lakhs. So 20 by 32 of the resulting NPV you can get and 12 by 32 of the resulting NPV I can earn. In that case, we say that projects are divisible. That is the meaning of projects being divisible. So when projects are divisible, you can make investment of flat 20 lakhs, whether it is project X or project Y. Then the comparison can be straight away made based on profitability index. Then NPV base does not come into picture, because if you invest equal amounts in the two projects, obviously project X will give you higher NPV, because project Y is demanding 32 lakhs and giving you so much of NPV. The moment you reduce the investment, the proportionate NPV will also reduce, which will fetch you overall lesser NPV in project Y. That is why you should take profitability index as a basis when the projects are divisible. So friends, when there is a conflict between NPV and profitability index basis, the first thing that you should look into is the fact whether the projects are divisible or not. If projects are found to be divisible, then you can straight away take a decision on the basis of profitability index. NPV will be just kept aside. That is the first concluding point. That means if the projects are divisible, task becomes easier. Whichever gives you higher profitability index, select that. Second possibility is projects are not divisible. That means if you want to take project X, you have to invest 20 lakhs. If you want to take project Y, you have to invest 32 lakhs. Now, when the projects are not divisible, obviously for project Y, we will need more money. For project X, we need less money. Do you think that this money is coming to us free of cost? Whatever money you are investing, we will be incurring cost towards this capital. So now there can be two possibilities. One possibility could be that we have abundant supply of capital. Other possibilities, we have shortage of capital. If you have abundant supply of capital, means you already have arranged 32 lakhs. Understand my point? You have already arranged 32 lakhs. If you invest 20 lakhs only, balance 12 lakhs will remain idle. If balance 12 lakhs is going to remain idle, anyway it is not going to fetch any benefit to you. In that case, you will be better off by investing all your money in project Y, because you will be getting rate of return of 10% on all your investment, plus you will be getting a higher positive NPV in case of project Y. However, in case of project X, you do get lesser NPV, but if you invest your money in project X, only 20 lakhs will get invested, 12 lakhs anyway will remain idle. That idleness of fund will also bring into account a negative factor, because that 12 lakhs is not getting any inflow, but that 12 lakhs is lying idle, as good as we have an outflow of fund. So in such case, when the projects are not divisible, what you should look into is, do we have shortage of capital or do we have abundant supply of capital? If we have abundant supply of capital, NPV basis will dominate. But if we have shortage of capital, you tell me what we should do. If we have shortage of capital, we should obviously invest each rupee sensibly. When I say invest each rupee sensibly, means I am pinpointing the basis of profitability index. So let me conclude the scenario before you write those notes. Point number 1, look into whether the projects are divisible or not. If they are divisible, profitability index will be a preferred basis. Second possibility, projects are not divisible and you have abundant supply of capital, NPV will become the proper basis. Third possibility, projects are not divisible and there is shortage of capital, then you would want to spend each rupee wisely. For that purpose, you should try to maximize the inflow for each rupee of outflow. If you have to maximize the inflow for each rupee of outflow, means your preferred basis will be obviously profitability index. Let us just move ahead and look into how we draw conclusion over here. We are mentioning in the conclusion that there is a conflict of decision in the two different bases, that is NPV and PI. PI stands for profitability index. On the presumption of shortfall of capital, first of all, you cannot presume on your own that the projects are divisible. So the basic assumption that you should take is that projects are not divisible. When projects are not divisible, within that there may be two possible outcomes or two possibilities. One is that you have abundant supply of capital, another is you have shortfall of capital. Because we are presuming that there is shortage of capital, we would want to maximize the inflow for each rupee of outflow, and that is where we would prefer profitability index as a basis. And finally, based on profitability index, we have drawn the final conclusion that project X is better. Quickly write up this conclusion and then we shall move ahead. Alright, I am sure all of you have already written this conclusion. Let us move ahead and write some important notes over here. So please put the heading conflict between NPV and profitability index basis. I have already explained, let us just write down some important notes. Generally, such conflict arises when the initial investment or total PV of outflows in the two projects are different. On the basis of NPV, projects having positive NPV are considered feasible for investment. On the basis of profitability index, projects with PI greater than 1 are considered feasible for investment. In situations where there are two mutually exclusive projects, both having positive NPVs, the adoption of one of the two becomes difficult when NPV and profitability index basis have a conflict. Let us move ahead and write up the later part. In such situation, the following procedure is to be adopted. Number 1, check whether the projects are divisible from the viewpoint of making investments. If yes, then simply profitability index basis should be used. Second point, in case projects are not divisible, profitability index basis should still be used if there is shortage of capital and the company has an objective of maximizing the inflow in terms of present value for each rupee of outflow. And third point over here will be, in case projects are not divisible and the company does not have shortage of capital, that is to say adequate capital is there and the objective of the company is to maximize the overall wealth, then NPV basis shall be preferred.